Okay, so the next term we're covering is bid and ask spread. So this is how the broker makes money. They make money is two ways, through charging a spread and charging a small commission. And the spread is also pretty small. So let's just read the definition. In return for executing buy or sell orders, the Forex broker will charge a commission per trade, or what they call a spread. This is how Forex brokers make their money. The difference between the bid and ask price is the broker's spread. So bid and ask means the buy or sell price. A broker could also charge a commission and spread on a trade, and they do. So they charge a spread and a commission, and it's fairly small, and I'll show you that. An individual looking to sell will receive the bid price, while one looking to buy will pay the ask price. Okay, so let's jump into MetaTrader 4. So right now we're looking at this gray line, and I've talked about this in a previous chapter a little bit, but I'm going to go over it in a little more detail this time. So this gray line is what we call the bid line, or when we're selling, we're looking at the bid line. So selling is the gray line, and it's referred to as the bid line. And when we're buying, there's an ask line. So I want you to right click on your chart and go to properties. And then I want you to click on show ask line. So here, this red line now that appeared, this is the asking price. And when we're buying, we're looking at the ask price. And when we're selling, we're looking at the bid price, which is gray. And the difference between these two is where the broker adds a little bit to the price to make their commission. So this is one way they make commissions, is by adding a little bit of what they call spread. This is called spread, and this is what they add. They add a few pips to the price of the asset you're trading to make commission per trade. So this is one way they make commission. So if you go up here and click on Market Watch, and right now we're on AUD USD. So I want you to just right click, if you already haven't done this, right click and go to spread. So it made this third column here, or this fourth column here, I should say. And this price that's moving, this isn't pipettes or points. So right now it's 13 pipettes or points, and that means it's 1.4, 1.5, 1.1 pips. So it fluctuates between 1.1 pips to about 1.56 pips, and it's always floating. So it's a floating spread, and this is what they call a floating spread. So it slightly fluctuates, and this is normal. Every broker works this way. It's not some sort of, negative thing. It's just how the broker makes their money. So if you actually measured this, the difference between this two, it would be the same as this unit here. It would be 1.4, 1.2, whatever the floating spread is, the difference in price. So the difference between the ask price and the bid price is spread. And the spread is always visible by just pulling up this little chart on the left here. So I'm just going to delete this. I just want you to remember that the bottom is the bid price and the asking price is a red line. So I'm just going to delete that. And I'm going to close this too. So when we're placing a trade, why do we care about spread? So spread, they're adding a little bit on top of the price. So it's usually, like I said, it's 1.4 pips. So I usually like to add 2 to 3 pips to your stop loss. So I'm going to place a trade here, and it'll make more sense to you in 1 minute here. So when I place a sell, so I'm going to sell, see how price opened up right here? This is the sell line, or the bid line, as we talked about. So price opened up here, and if you see down here, you see a negative number, right? That negative number is because we placed a sell on this gray line, but the trigger for our take profit or stop loss is the red line. So because the difference here is spread, remember, this gray line when we're selling is the line that we look at when we place a sell, but the red line, because we need to account for the broker's spread is what triggers our stop loss or take profit. So I'm going to go ahead and just drag a stop loss, and I'm going to drag a take profit. So because we're selling, we're looking at the red line. So the red line will be the trigger for the stop loss, and it will also be the trigger for the take profit. So some students, maybe they've seen this gray line and it goes to their take profit, and they're wondering, well, why wasn't this trade triggered to close? Because we're actually looking at the red line. The red line is the trigger for your stop loss and take profit. I want you to remember that for when you're selling. So when you're selling, it opens up the trade on the gray line, and then when you're looking for take profit or your stop loss gets hit, it's this red line. So what I also want to tell you about spread. So because spread, looking at this table here, right now it's floating about 1.5 pips. That means if you're setting, say, you've marked up on TradingView and you've decided to use a 15 pip stop loss, you know where your stop loss is, but because of this spread, I want you to add, like 3 pips more to account for this spread. So this little extra bit here is the broker's commission, and you need to increase your stop loss to account for the spread. So spread right now is 1.5 pips. So you need to add 1.5 pips or 2 pips or 3 pips. I don't like having too much of a tight stop loss. It depends on the setup, but there's a term that I've learned in the past. There's a saying that says, give your trade enough room to breathe, right? Because as price fluctuates, you have a little bit of a floating spread, and you also have, little fluctuations that happen in the market, and you don't want your stop loss too tight because it's going to be triggered, and maybe you won't want it triggered, right? So that's why give your trade a little bit enough room to breathe. So whatever you calculate, based on your markups, what you want as your stop loss, you have to add in the amount of spread that's floating. So I always like to add, I go on average I add 3 pips to my stop loss. That's just, a number that I use. So 3 to 4 pips, depending on how the market, how choppy it is. You want to give your trade enough room to breathe. So I'm going to close this trade, but before I close this trade, so I want you to see how there's a negative number when you open the trade. It's because when you open a trade, you're automatically 1.5 to 2 pips back, in a loss, because you have to add in the fact that the broker's commission. So that's why you're always, when you open up a trade, you're going to be a little bit of negative. And then brokers also charge a small commission. So they charge $5 per one lot, but one lot is huge. We're not trading one lot. So as your trade position size is smaller, your commission, is going to be, that the broker is charging you, is going to be smaller. So here on this trade, we're being charged 5 cents to place a trade. It's a 0.01 lot trade. It's fairly small, so the commission is very small, and then the broker adds a little bit of spread, and that's about 1.5 pips of spread. And again, we just add that to our stop loss because we don't want our trade stop loss too tight. Otherwise, we might get stopped out when we don't want to be stopped out. So I'm just going to close that trade. So we were selling here, and now I want to place a buy order. So look, when I hit buy, look where the line actually shows up. So our buy order, look where it shows up. So our buy order now, instead of the gray line, it opened on the red line. And now, so when we're buying, we're actually looking at the gray line. The gray line is going to be our trigger. So when we're setting a stop loss and a take profit, so now we're looking at the gray line. The gray line is going to be the trigger. So remember, the red line was the buy line or the ask line. So when we hit buy, it opened up on this red line. So the gray line is now going to be the trigger. So when we're looking at our stop loss is going to be triggered by the gray line. And then when we're looking at our take profit, remember, it's not going to be this red line. When this red line approaches this TP, that's not going to be the trigger. It's going to be this gray line. And that's because we just have to add in the spread. So whether we're buying or selling, it's always, you have to account for the spread. And same thing goes here. So when I'm setting a stop loss, say I'm setting a stop loss of 10, 15 pips, I want to add this extra bit here. This is what we call spread. So the spread right now, we can double check. The spread is 1.3, 1.4 pips. I like to add I actually like to add at least three pips, and have a decent stop loss that's not too tight. So the main thing I want you to know is, because some traders taking this course weren't aware, and they were wondering why sometimes their take profit or stop losses were being triggered at odd times, is because most likely they didn't have their ask line showing and they weren't aware of which line is the trigger. All right. Okay, and one thing I wanted to also talk about is a myth that often comes up. So when something negative happens, like we get stopped out, or something, things happen while we're learning, and even when we're on our live account that we didn't expect, and sometimes we tend to, in the past I've seen people, they tend to, sometimes blame the broker, and they think that the broker, wants their money, or they want them to lose because they want to make profit. But that's absolutely not true. And like I showed you here, the broker makes small commissions per trade. So they make a little bit of commission per trade, and then they make a little bit of commission through spread. So when we win a trade or when we lose a trade, the money that comes into our balance here, the money we gain or the money we lose, that does not come from the broker. The broker makes small commissions per trade. That's all they do. The broker is our agent for placing trades. They do not make money when we lose money or when we gain money. That money comes and goes to the liquidity provider. And they're the ones, the big banks, they're the ones buying and selling large amounts of assets, and we're trading with the big banks. The brokers are just what a broker does. They're just the middleman who connects us through a computer. So make sure you use a broker that's an ECN. We talked about ECNs, so we don't have any actual human in between. We don't have a human middleman. We have a computer that links us to the big banks, the liquidity providers. So that's where our money comes from. That's where money goes. The brokers actually want us to win. I want you guys to actually believe that and know that. The brokers want us to win and trade for the next 5, 10, 15 years, because then they're making little commissions every trade for the next 10 years, right? If you deposit $300 and you lose that money and then you never come back to trading, well, the broker will never make any more money. They will make way more money if you trade for 8 years and take a little commission off you, instead of you losing your money and never trading again. So that's one myth I wanted to make really clear for you, that the brokers make commission with spread and small commissions per trade. They have nothing to do with our profit or losses. And just a little comment about brokers. I've given you guys a recommendation to use, the broker that I've recommended to you guys. It's up to you which broker you want to use, but that's why I'm going over all these terms, because I really need you to, when you're choosing a broker, you need to look at spread, you need to look at commissions they charge, and you also need to look at leverage. And then after you figure out, whether you like their spread or their commission, because some brokers offer you a small spread, but they charge you more commission. Some brokers offer you a decent, a small spread, but they also charge you a small commission. So all brokers are a little bit different how they make their money, but brokers make a small commission through spread and commission per trade. And then once you figure out all that and you like their spread or commission or leverage, then you have to find out is if they even accept your country, because every country has different laws, and Canada and US, like I said, after the US housing crisis, a lot of countries don't like to include countries that have really strict lending laws. And for beginner traders, we like high leverage because it means we have to deposit less money to trade large sums of money. Okay, so let's now go back to swap fees. Okay, so what are swap fees? Let's read the definition. A swap or rollover fee is charged when you keep positions open overnight. A Forex swap is the interest rate differential between the two currencies of the pair you are trading, and it is calculated according to whether your position is long or short. ECN brokers pass their fees to the retail trader, which is charged by the liquidity provider. So I want you to know that swap fees are interest rate fees. We're trading money, we're borrowing money. You have to pay interest on those, and they're small interest because we're placing fairly small trades, but someone has to pay that interest. And again, the broker is not making money off these swap fees. They're passing it on to the liquidity provider, the big banks, because they're being, they're the ones lending money and charging interest rates, and they control all of that. So again, don't blame the broker for the swap fees, and they don't get that money. So I just want you to know that. Okay, so let's just take a quick look here in TradingView about swap fees. So if we come right here and we go to Market Watch, and you can do this on any assets, but we'll just stick to AUD USD. So if we right click on here and go to specifications, you guys spend some little bit of time in here just reading what it says in here. And what I want to bring to your attention here is here, every asset, it'll tell you the swap fees. So long is when you're buying, short is when you're selling. So they charge, and this is per one lot, so we're not trading one lots, but they charge negative 1.58. So it means they will charge you $1.58 per one lot. And so if you're trading smaller lots, or if you're trading, then you're going to pay a fraction of this interest, right? So it's fairly low. So when you leave trades open overnight, you get charged this fee right here. So swap long is negative 1.58 and swap short is 1.51. So it's fairly close to the same number, but you can look in here for detail about any asset you're trading. For example, trading oil is a bit more advanced, but oil actually has a positive swap fee. So it's not very much, but let me take a quick look at it here. So it has a $1.53 positive swap. So like I said, the broker's not getting this money. We're paying this to the liquidity provider. They pay swap fees or they charge swap fees. It depends on the asset. And a lot of Forex, I don't think any Forex pairs actually pay a positive swap. I might be mistaken, but you guys can check it out. Whichever your favorite pairs are, once you master AUD USD, I'm sure you guys will trade other pairs. Some of you have already started doing that, but you can always just go here, check, and go to specifications, and you can look right here. Actually, Euro odd, it has a positive short swap. So when you're selling and you leave a trade open overnight, so say if you leave a trade open for a month, you will be paid 1.5 or $1.50 per one lot. You're not trading one, maybe you are, one lot is pretty big, but my point being is that some assets actually pay you a positive swap. So always just go into this little specifications. You can also do this, if you want to look it up on your phone. Same thing. I believe you just long hold and go to details, and you'll get the same thing. So in here, you can read about the actual asset. There's good information in here, and it also has the market hours. So some trades or some assets, for example, oil, close a certain part of the day, and just be aware of what's in here. It's good information. Okay. Why I'm kind of emphasizing swap fees, triple swap. So on Wednesdays, and actually it's Thursdays, Fridays, you're charged something called triple swap fees. And some people also think this is a scam, that, oh, why is the broker charging me triple swap fees? So again, what is a swap fee? Swap fee is interest you're charged when you leave your trade open overnight. So for example, day traders, the reason why they're called day traders is they open trades that day and they close their trades before the end of the day. So they're not charged any swap fees. So if you're trading long term, which is more than a day, so if you let your trade stay open overnight, then you're charged interest rates because you're borrowing money for longer than a day, right? And so let's read what triple swap means. Triple swap rates are charged on Wednesday. The reason for that is spot Forex contracts have a 2-day settlement period. For example, a spot Forex contract that occurs on Monday settles on Wednesday. A trade that occurs on Tuesday settles on Thursday. A trade that occurred on Wednesday settles on Friday. But a trade that occurred on Thursday settles on the following Monday. In this example, the trade that occurred on Thursday rolled over through the weekend. Because the banks are closed on Saturday and Sunday, triple rollover interest is applied to the position held open at 5 p.m. New York time on Wednesday, as this marks the beginning of a new 24-hour day, Thursday. So this means when you close your trade, it actually, in the back end that we don't see because we get our profits or losses right away, it actually takes 2 days to close your trade in the books, in the banks, and whatever happens in the back end. We don't see that. But if you close your trade, so on Wednesdays after 5 p.m. New York time, so that's Eastern time, that when you leave your trade open past, so it may still be Wednesday for us wherever you're living, but at 5 p.m. New York time, that marks the new trading day, and that's actually Thursday. So on Thursday, which starts 5 p.m. on Wednesday, you're charged triple swap. So 3 swap fees, 3 days of swap in a row, because your trade will not close because it's going to fall on the weekend. So they charge you interest on the weekends. Again, this is not some scam. People think, oh, why is this broker charging me triple swaps on Wednesdays? It's just what happens, right? You're leaving your trade open overnight. It's going to be closed on the weekend. You're going to be charged triple swap. That's all. That's how it is, right? And if you don't want to be charged swap fees, then close your trade before it rolls over to the next day. And I'm going to show you how you can tell when the trades are going to roll over. Okay, so the next thing I want to show you is I don't recommend you keep this on your chart because it's going to clutter your charts. But if you right click on your charts and go to properties and go to show period separator. So this actually shows you when the new day starts. So right here, new day, here, new day. So if we go to the 1 hour chart, you can see it starts cluttering up your charts, right? So this is why I say you don't want to really have them open, because say if you're looking at your 4 hour chart, it just, I don't know, it just adds more clutter to your charts. We don't analyze at all on MetaTrader 4. We do it on TradingView. I'm going to show you how to show the period separators or sessions. They're also called market sessions. This is where you don't, if you leave your trade overnight, if it crosses this point right here, this is where the swap fees happen. So when you leave your trade open overnight, a new session is starting, this is where swap fees happen. So I know some students started recognizing, they're like, well, the market starts printing weird candles around here. So you see how here it went from here and it dropped down? Well, that's because the market closed and then reopened. And this happens, for me, it happens 2 p.m. every day. So just remember, what we read here, it said 5 p.m. Eastern New York time, because everything goes by New York time. I'm on the Pacific, so for me, it happens every day at 2 p.m. That's when the market closes. A new session starts. This is when you get charged, rollover fees or swap fees. And it's also when, I want you to know that, also look at right here, spread. So spread, usually it floats about, for AUD USD, it floats about 12, 13, it's pipettes, so it's actually 1.4 pips. So, but when the market opens a new session, this happens on Sunday too. I know a lot of people love to get into the market Sundays, but I just want you to look on Sundays and when we cross over to a new day. Because we're opening into a new market, the liquidity or the amount of access to these currencies during market open times, the liquidity, they call it, the liquidity becomes low. And when the liquidity is low, the spread increases. So, it almost triples. So sometimes you'll see this at like 20 or 30, which is like, 2 to 3 pips opposed to 1.2 pips, right? So when the market is opening and closing, you're going to see the spread increase. And that's why usually, people don't trade right on market open, or they don't trade on Sunday's market open, because right at the opening, because the spread is a lot higher. And like I said, when you're placing a trade, and if the spread is a lot larger, that means your stop loss has to be larger, right? So here, let me put it, normally say if the spread was only like 1.5, 2 pips, then you can have a closer stop loss. But on Sundays or when the market moves over, if the spread is tripled because the liquidity is low, then you have to use a larger stop loss. So, and this is another myth. I want you guys to really focus on these details, because this is another myth that just bothers me when they talk about, again, it's, they say that the brokers are manipulating the markets, they're adjusting the spread and yada, yada, yada. No, they're not, because the markets are closing, the liquidity is low, the brokers are passing on the spread fluctuations that the liquidity provider. So when the liquidity provider if it's less liquid and there's less available to hand out to people because there's, the markets are opening and there's less liquidity, the spread increases, and then the broker has to increase their spread. So it's not a scam, it's just how the market works, right? If you don't want to be charged swap fees, don't leave your trades open long term. If you don't want to be charged triple swap fees, well, don't let your trades fall into that 2-day close period. And if they close on the weekend, then you're going to be charged triple swap for the weekend. That's just how it works, right? And when the markets switch over, you see how here you see this big gap here, you're going to see higher spreads during that period. And it's going to result in you having to have either a larger stop loss, or if you don't adjust your stop loss, your stop loss is just going to get hit and you'll be upset. So instead of being upset and trying to look for, people to blame, which people end up doing, let's just be aware of how things actually work, and we can trade around them or we can accept the outcome, like having to have a larger stop loss. It's just how the market works. I'm all about, if there's something you don't understand, research it, right? Don't just come up with, blame people. I really I've seen other students, and it's not just students, it's just people all over the internet. They when something doesn't seem right, research, do some Googling, go to your broker, do the live chat, talk to them, ask them questions. A lot of you aren't using the broker live chat. When you go to the live chat, it's the bottom right corner. Yes, they have it's a robot or a bot, but if you just hit no, no, no to no, you didn't answer my questions, they'll give you an agent, a live agent. So, so always try to talk to a live agent. Ask them about swap fees, or ask them about, anything about margin calls. Do your research, right? I want you guys to really, focus on researching and educating yourself, because, I love just researching and finding out things. And, now I'm making these lessons for you guys because I just, just like you have the ability to educate yourself, and I did the same thing. We are no different. So please put an emphasis on research and understanding. Okay, so I hope you understood that, and let's go to the next term.